This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Stall speed, the sluggish growth of the winter extended into the spring, raising new concerns about the health of the U.S. economy.
Crude realities. Profits drop sharply at two of the world's largest oil producers as low crude prices challenge big oil.
Big promise is the much-hyped smart home not so smart after all. All that and more tonight on Nightly Business Report for Friday, July 29th.
Good evening, everyone, and welcome. The S&P 500 hit an intraday high, but closes just shy of one. But when it comes to the economy, there was no spring revival. The economy expanded much less than forecast in the second quarter, surprising investors who were expecting a pickup following the weak start to the year. The Commerce Department reported a 1.2% rise in gross domestic product, the broadest measure of goods and services produced in the nation. Estimates were for an increase of 2.6%. And growth for the first quarter was revised lower, raising questions about the pace of the 7-year-old economic recovery and what the Fed might do next. Steve Leisman has our story.
Amid the heat of summer, Wall Street got a blast of cold economic air on the economy. The government reported tepid growth for the second quarter of just 1.2%, more than half of what economists had expected. And the report showed the prior two quarters were weaker than originally thought, and it raised worries the economy could be slowing down sharply. Curiously, consumer spending did well. It was business investment that kept growth down.
Consumers are the economy. That's a piece that matters. That's reflective of strong payrolls and fairly resilient wages. So that's the piece that matters. That business investment component, companies continue to give money back to their shareholders vis-a-vis share buybacks or dividends or whatever. They're not willing to make that investment, and that trend hasn't changed.
Business investment has now declined for 3 straight quarters, and some believe it only gets worse from here as concern about Britain's leaving the European Union and the U.S. presidential elections could keep CEOs from greenlighting tech and equipment spending. But some economists point to a sharp decline in inventories as a reason for optimism. They say companies are unlikely to keep destocking their shelves at the rate of the second quarter, so inventory building could help future growth. They also believe government spending growth will rebound. One help for the markets, the weak growth seemed to rule out additional tightening from the Federal Reserve.
The odds are going to play sub 50% that the Fed's going to move a quarter point in December, but I think the odds of that are decreased in so much as international factors, Brexit, what's happening in the Bank of Japan. So I think the Fed is going to be more cautious.
A word of caution. GDP reports are subject to sometimes large revisions. Actual growth numbers could be revised to be as little as 0 or as much as 2.5%. But for now, investors have only the current numbers, showing they have to think more about a weaker 1% economy than a 2% economy. For Nightly Business Report, I'm Steve Leisman.
So what does today's GDP report suggest about the health of the U.S. economy? Jim Kahn is Chief Investment Officer with Wealth Enhancement Group, and he joins us now. Jim, welcome. Good to have you with us. Does today's number, which is probably, I would characterize it as worrisome, suggest that the economy is dangerously close to slipping into negative territory, or that monetary policy, the Fed, low interest rates, have lost their power to do anything?
Well, let's be honest, right? Today's report was clearly disappointing. Growth at sub 2% in this economy right now is very disappointing to see. But if we look at the underlying factors related to business investment, and the second quarter had some very unique characteristics, especially around the Brexit decision. I think if you look at the markets now, it's almost like Brexit never even happened. But if you were a CEO sitting there in early June, making a decision about whether or not to build a plant, invest in more productivity, put in a new CRM, whatever it might be that you need to grow your business, Brexit weighed on your mind and you didn't make that decision. Now, on the flip side, you might say, look, are we reaching stall speed? Is this the speed at which the economy is going to turn around and plunge into recession? And I think that the data would point to the fact that this is not. And if you look at consumer spending was up 4%, which means that the consumers are starting to feel the benefit of lower unemployment. Unemployment in this country is at 4.7%. They're starting to feel the benefit of some wage growth. Right. It's tepid, but it's starting to pick up. And people are feeling a little bit better about their prospects.
So what do we do then with this report? Is it like that kind of fluke in the unemployment figures that we got earlier this year? Do you put that aside? given what you just laid out with Brexit, do we ignore this report and wait and see for other evidence of economic expansion?
Well, I wish it was that easy. I think the first thing we need to do is reset sort of what our expectations are for GDP growth. So if you talk to most economists, they'll say that GDP should grow at about 3% in the U.S. That's what it's grown at historically. But if you look at the decade between 1995 and 2005, new workers entering the workforce grew at about 2.1% a year. Over the last decade, we've only seen workers entering the workforce at 0.5% a year, which means that productivity, in order to get back to that 3% number, has to increase by 1.5% a year. So if I look at the productivity growth, if I look at new workers entering the workforce, I think we should be really happy if we get this economy growing at 2.6%. I think we have to look forward to the third quarter, and we have to ask ourselves if the inventory burn-off in the second quarter was sufficient, and if we get enough clarity around geopolitical issues, and we don't see a pickup, we should worry.
All right.
If we do see a pickup, then I think we're probably on a pace for continued strong growth.
All right, Jim, thank you very much. Jim Kahn is Chief Investment Officer with Wealth Enhancement Group, and later in the program, given the strong consumer spending component of the GDP report, our Market Monitor has some consumer-related stock picks to make you wealthier.
Speaking of the consumer sentiment fell slightly this month. The University of Michigan's index for July shows that higher-earning Americans see Britain's exit from the European Union as cause for concern. The report noted that global uncertainties, as well as the presidential election, will keep some consumers cautious.
On this last trading day of July, the Dow posted its 6th consecutive month of gains. But for the day, stocks, like the economy, just didn't move much. Here are the closing numbers. The blue chip Dow index off 24 at 18,432. The NASDAQ, however, rose 7 points to its highest level this year. And the S&P 500 was up 3, and that was just shy of a record. For the month, NASDAQ was the big winner, up more than 6%, as you see there. But recently, stocks have been trading in a narrow range. And as Bob Pisani reports, August has the potential to shake things up.
Okay, we're entering August. Now here's the bad news. August is traditionally poor for the stock market. In fact, it's the worst month for the S&P since 1987. While it's traditionally a poor month, it's usually on light volume and low volatility unless there's some crisis. There was one August 24th last year when the Chinese devalued their currency. There was one in August 2011 when the Greek government debt crisis happened. Then there's the election, which is a real wild card. First, there's an unconventional candidate in the form of Donald Trump. Then there's a little history problem. There's no incumbent running. According to Merrill Lynch, since 1928, the S&P has dropped an average of 2.8% in presidential election years that don't include an incumbent seeking re-election. But in years when a sitting president is up for re-election, the S&P has average returns of 12.6%. Now, why is that? The theory is that incumbents tend to obsess over economic issues and promote market-friendly policies, according to Merrill. All right, is there any good news here? Well, actually there is. A lot of these old trader saws are not working. So take sell in May and go away. Remember that? Well, that's not working again this year. The S&P is up 5% since the start of May. Maybe August will be a winner after all. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
New cancer and hepatitis treatments helped Dow component Merck post an unexpected increase in second quarter revenue. Merck has been trying to grow sales with new medicines after several years of declines, offsetting the loss of some of its treatments to generic competition. Earnings and revenue both topped Wall Street expectations, and shares managed to finish the session up slightly.
Oil prices steady today after a week-long sell-off. Domestic crude settled up today, about 1%. But for the month, it's been a bad one. Crude is down sharply, 17%. It is those low oil prices that are hurting big oil. ExxonMobil and Chevron reported results that were well below expectations. In fact, ExxonMobil reported its smallest profit since 1999. Shares of Exxon fell while Chevron rose. Jackie DeAngelis has more on big oil's big miss.
The main issue for ExxonMobil and other energy companies this quarter was international growth and continued low commodity prices, even though crude oil got a slight bounce in the second quarter. CEO Rex Tillerson said the industry environment is volatile, so the company is focusing on cost controls. Refining did help the bottom line, even though margins were squeezed, and the company will maintain its dividend of 75 cents a share. Chevron earnings were a few cents better than expectations, but there were some impairments that impacted the bottom line. Also, a dividend darling, the company maintained its payout of more than $1. But the energy majors have been cautious, signaling a challenging road ahead, and that view is far more cautious than the rest of the street.
We remember what happened last year, fourth quarter, and this year, first quarter, where demand basically fell off the cliff and oil wasn't being used. Oil is a very seasonal market. Once that season ends, demand dries up. If you continue with the supply the way it is, you're going to see prices trade into the lower 30s.
Meantime, cost cuts are generally a positive in challenging times, but there comes a point where only so much can be done. And analysts are also questioning how sustainable dividends are. Cash flow is tight, and oil prices look like they're taking another dip down. The immediate future appears to be murky for the energy industry, with crude prices falling into a technical bear market territory, meaning they're down 20% from their June high. There could be a rough road ahead. Reporting from the NYMEX, I'm Jackie DeAngelis.
Still ahead, some of the hottest stocks of this sizzling summer. The computer network of Hillary Clinton's campaign was reportedly hacked. According to Reuters, this is part of a broad cyber attack on Democratic political organizations. It also follows two other hacks, one on the Democratic Fundraising Committee for candidates for the House of Representatives, and the other the Democratic National Committee.
The tech sector led the market this week and this month, making technology the hottest group of the summer season so far. Landon Dowdy tells us which stocks are sizzling.
Summer is traditionally time for investors to set it and forget it when it comes to portfolio management, but there are some stocks that sizzle during the summer months, specifically in the tech sector. Out of the 10 sectors in the S&P 500, tech is up the most since the summer solstice, jumping 8%, and it's been a top-performing summer sector for the past 6 years, but on average, tech lands in fourth place on the list of the 10 sectors. So what specific stocks are sizzling? Seagate is up more than 40% summer to date thanks to positive guidance earlier this month on the heels of a restructuring plan. Linear Technology and eBay both up 31% this summer. Linear stock has turned around this year after the firm received a bid from Analog Devices for about $15 billion. And as for eBay's hot streak, the e-commerce company reporting earnings last week, a very positive same-store sales and solid full-year guidance, which has helped push that stock higher. And after strong results from Amazon, Facebook, and Google, the sector may get even hotter. For Nightly Business Report, I'm Landon Dowdy.
Higher deliveries lift revenue at UPS, and that is where we begin tonight's Market Focus. The world's largest package delivery company beat sales expectations in its latest quarter, while profit also rose and matched estimates. The company also reiterated its earnings guidance for the full year. Shares of UPS fell fractionally, though, to $108.10. Profit was cut in half at Phillips 66. The energy company said a gas glut impacted the company's refining margins, but earnings still managed to beat expectations. Revenue also fell, but it came in shy of estimates. Shares were down 19 cents to 76.06. Strong demand for trucks and SUVs helped lift sales at AutoNation, but that still wasn't enough to beat estimates. The auto retailer did, however, report profit that was better than expected, so shares were up more than 2% to 53.35. Cigna is lowering its full-year outlook as the health insurer posted profits for the quarter below expectations. The company cited weakness in its group disability and life division, but revenue did rise, and that beat estimates. Cigna shares fell, though, 5% to $128.96.
Currency headwinds and weaker sales dragged down profit and revenue at Bloomin' Brands. The parent company of Outback Steakhouse did manage to beat earnings targets, however, although its revenue did come in a little light. The company also issued guidance for the year that was below forecasts. Shares down 97 cents to $17.98. The board of directors for the beer maker SAB Miller said it will recommend shareholders approve the sweetened takeover offer from rival Anheuser-Busch InBev. The revised bid, which we reported on earlier this week, was for more than $100 billion. Shares up 2% to $129.44 of Anheuser-Busch. Shares of Seres Therapeutics plunged today after the biotech company said its drug intended to treat an intestinal disorder failed a test trial. The company said it will work with the Food and Drug Administration to make potential modifications to the treatment. Shares down 69%, ouch, to $10.94. And several private equity firms may be exploring a buyout of information technology company Hewlett-Packard Enterprise. This, according to the website The Information. The potential deal could be worth more than $40 billion. Hewlett-Packard declined to comment on the news, but shares did rise 3% to $21.02.
And now to our market monitor, who likes stocks that he says should benefit from rising consumer spending. When he was on in October of 2015, he recommended Disney, which is down 8%, Home Depot, which is up 14%, and United Healthcare, which is 23% higher. He is John Trainer. He is the Chief Investment Officer at People's United Bank's Wealth Management. Good to see you again, John. Welcome back.
Good to see you. Thank you.
Let's get to your stock picks. Disney, it's had some rough going, however, but I was just at Disney, and people were certainly spending. So you still like the stock?
Absolutely. We want to be exposed to the consumer, but what we really like about Disney is content. If you look at Netflix, you look at Hulu, all of these new delivery technologies, they need content, and that's what Disney does. They stumbled because of some concern about ESPN, which is a real concern, something that we're watching. Are people turning off the cable box and going somewhere else? Well, when they go somewhere else, they still want that content. So we own Disney, and we think this is a great time to add to a position if you own it currently.
Number two is Microsoft. You say a price of $60 is in view within 12 months.
Yep, that's a fairly conservative estimate, and we would love to be surprised on the upside. What Microsoft is doing is and I don't know if it's appreciated by a lot of investors, they are dramatically changing their business revenue model, moving away from a release of software where they get a big rush of funds to a more annuitized revenue stream as they move their business to the cloud, which is it's a great move for them. We think that could actually lead to some PE multiple expansion if they become more and more successful. So that shift in revenues to the cloud is going to have a big impact on Microsoft.
And you also like Starbucks with a price target over the next 12 months of $61. And you're looking at their long-term potential here, specifically as it relates to China.
Correct. If you take a look at their earnings report, they disappointed on U.S. comps, but China, the comps were a little over 7%. So they had a very good report from our standpoint on the international side. Plus, they're expanding. They've got the mobile app where you can order through your phone to get your order set, your latte set before you get there. Mm-hmm. So they're doing a lot of interesting things.
July was perhaps, John, a surprisingly good month in light of the Brexit vote and all kinds of other things that were going on. What do you see between now and Election Day, August, September, October?
You're correct. July was a very good month, and what we liked about it was much more of a risk-on type market where people focused on those companies that are growing earnings. It wasn't driven by the defensive stocks, the utilities and the telecoms. So it was the structure of the market rise was very, very helpful. What we think we're going to be focusing on between now and especially you talked about the month of August earlier, the election and the economy. We had the GDP number this morning, and we actually liked it. I know the initial number wasn't good, but if you look at real final demand, that was about 2.4%, which is what we expected. So we liked the number. You're going to have the employment number next week. We think that will be a good number. The more investors focus on the economy, the better off we think the markets are going to do. I'm a little bit of a political junkie, so I watched both conventions, and I can tell you the election, it's going to be exciting. It's going to be exciting, and it's probably going to be a little confusing for investors.
Yes,
you bet.
Indeed. John, thank you so much. Have a great weekend.
Thank you.
John Trainer with People's United Bank's Wealth Management.
Well, coming up, the promise of the smart home was big and cool and high-tech, but the reality is turning out to be something different.
And here's a look at what to watch for next week. Monthly auto sales are out for July. Also, on Tuesday, two Dow components report their earnings, Pfizer and Procter & Gamble. The biggest release comes Friday with July's employment report. Investors will want to see if the bounce back that we saw in the last report has held. And that's what to watch for next week.
A number of startups are settling down just north of California's Silicon Valley. Portland, Oregon's Silicon Forest is fast becoming an entrepreneurial hub for health and fitness companies, and it lies, of course, in the shadows of Nike's headquarters. Kate Rogers is in Portland tonight.
While the U.S. men's gymnastics and diving teams prepare to hit the international stage in Rio, one startup in Portland is helping them go for gold. APDM Wearable Technologies created custom wearables for Team USA to do more than just count steps. These devices study the quality of each move they make so that coaches and athletes can analyze the data to enhance performance.
We can capture like a gymnast running up to a vault, and so we can look and characterize their body movement. So looking at efficiencies, so are we trying to improve their speed? So let's look at efficiencies. Or if we're trying to improve their rotations, let's look at their form.
The intersection of fitness and technology make Portland a great place for APDM to call home. Local resources like the Portland State University Business Accelerator, where the startup is based, have also helped give Portland's ecosystem legs.
There's just an abundance of highly qualified, highly educated people that are available to startups right now. And the other is that we're seeing more and more availability of money and funding here.
Venture capital funding in Oregon hit a 5-year high in 2015, according to Dow Jones Venture Source, proving investors aren't shying away from good ideas outside of New York and San Francisco. More broadly, the Portland Metro was ranked a top 5 location for small businesses in 2015, according to data from the Kauffman Foundation.
Fitness and nutrition are thriving industries here in Portland, with athletic powerhouses like Nike, Adidas, and Columbia Sportswear calling the area home, and now newcomers like Society9 are getting into the ring.
Lynn Lee got her big idea teaching kickboxing and noticing a common problem among female fighters. Their gear didn't fit properly.
It's a community I'm passionate about, and these women deserve, their athleticism deserves respect, and the way to get to that point is by saying to them, you deserve product just as good as men's.
She took that message nationwide in 2015, first on Kickstarter and now on the web and in a handful of local gyms. But Lee is staying true to Society9's Portland roots.
There's also a really strong community of fostering local artisans, local businesses. And so between that type of camaraderie as well as the work-life balance and the environment itself, and then you lead that with the sport innovation culture that's here, it's really a hard place to beat.
One thing's for sure, Portland startups aren't trying to find their way out of the Silicon Forest anytime soon. For Nightly Business Report, I'm Kate Rogers in Portland, Oregon.
Kate packs a big punch there. All right, to read more about Portland, Oregon's startup scene, head to our website, nbr.com.
A number of tech companies want to make your home high-tech, allowing you to control your thermostat with your phone or communicate with your refrigerator. But is the smart home really smart, or is it still just hype? Aditi Roy reports.
Smart home gadgets like the Nest thermostat, Samsung's smart fridge, and Amazon's Echo promise to save time and increase efficiency around the home. But there are real challenges preventing mass adoption, as we learned when we tested out the August Lock's new integration with Amazon's Echo, which is supposed to make it easier to lock your home. Here's how it works. First, you install the August Smart Lock, the Bluetooth lock, and the Wi-Fi bridge needed to make the connection. Next, set up your Amazon Echo with the Alexa voice recognition built in. Then you'd give the command, Alexa, tell August to lock my front door. Assuming the Wi-Fi is working, your door should lock. That's how it should work, but when we took part in the demo, it wasn't so seamless.
There was a problem with your request to lock the lock.
After several tries, it finally worked.
August checked the demo door and it was locked.
If you're wondering why anyone would go through all of these hoops, August CEO Jason Johnson told us that the company decided to integrate with Amazon's Echo based on customer feedback.
the challenge is if you have to use an app for every device, a smart lock or thermostat or lights, it's a bit cumbersome. And so, what Alexa is doing is allowing people to not use an app at all and just use their voice. And I think our customers and people using these technologies really appreciate that convenience.
In order to take full advantage of this technology, it will cost you. The Amazon Echo will run you about $180, and then add in the cost of the August smart lock and the Wi-Fi bridge for a grand total of $460. According to Juniper Research, the smart home market could reach $71 billion by 2018, up from $33 billion in 2013. But a number of roadblocks still stand in the way, including security, hacking concerns, frustration over the installation process, and cost. It's no surprise that some analysts say that these obstacles represent a barrier to mass market adoption of smart home tech.
Practically speaking, it's really difficult for people to integrate it right now. You've got all kinds of different technical standards. You've got products that inexpensive, maybe one at a time, but when you add all the ones you need for your home, makes the entire exercise very expensive. And frankly, then a lot of questions of, is this really worth my money anyway? And how much value am I going to get out of it? So it's a very tough time right now for smart home. It's not living up to the hype that it certainly received for a long time.
One solution, according to McDonald, is to rely on big servers like AT&T to bundle and install the technology for you, which would take the guesswork out of bringing the technology into your home. For Nightly Business Report, I'm Aditi Roy, San Francisco.
Or you could just use a key.
Yeah, right? Keys will work fine for me.
Keys work fine.
Aye.
Just a thought. Right. All right, that does it for Nightly Business Report tonight. I'm Sue Herrera. Thanks for joining us.
And thanks from me as well. I'm Tyler Matheson. Have a great weekend, everybody, and we'll see you here on Monday, August 1.